morning, Bob. How are you?
I'm doing well. I'm actually I'm on this session for the first time, I think, from the office, and it looks a little less like my super secret bat cave, but yeah, it's good. It's good to be here, and looking forward to the discussion today. We'll give people a little more time here before we start really going through the presentation, because as we say every week, it takes a little time for people to connect once we start broadcasting. I think that the topic today, though, is an interesting one, and let's give it about 10 more seconds, and then we'll let you get rolling here.
Yeah. Well, I hope to, we've kind of, it seems like a portion of our office has been working. We were working remotely, all of us, and then, back in the office, and now we've kind of, I think a lot of people out there kind of have twin offices at this point. So I'm hoping to transition.
Yeah.
This is actually, I was at the office every day last week, and that was good. And I actually want more of that. So.
All right. Well, I think
probably in at this point.
Yeah, let's go ahead and get started.
Yeah. So today, thanks everybody for joining us. Today we're going to be talking about stock indexes, and specifically two main types of them and how they differ. So I know, Bob, you've been helping families with their finances for about, I think, 35 or 36 years now. What has been your experience in meeting with people in terms of, have you heard people over the years change which index they refer to, and how have you perceived clients interpret what those are?
Yeah, it's been a massive change, Zach, since 1984. Back then, for really probably the better part of 10 years of my initial career, it was always every night on the nightly news. That was back when there was really 3 network channels for news. The web didn't exist yet. There were cable channels just at the infancy at the end of that period, but it was always about the Dow Jones Industrial Average. And we have a poster somewhere in our office still from the first time that the Dow broke 10,000, that was the focus. And of course, that changed. Today, though, I think a lot of people who are my age and older, old habits are hard to break. And I think they still think of the market in terms of the Dow, and that still is quoted pretty regularly, even on, 24/7 cable channels and whatnot. But really, It's only 30 companies. I know you're going to get into that today. And the one that people tend to talk more about these days, I guess, would be the S&P 500. And I think you've got some really helpful and interesting insights about even that index today. So we like to break this stuff down and make the complex simple. And sometimes when you start talking about indexes and ETFs and all this stuff, our eyes can glass over and we kind of get lost in the weeds. But I think the beautiful part of these weekly discussions is that we can take a simple idea like this and really break it down to, some things that people need to understand, but make it simple to where it's not boring. And when you hear the S&P 500 after today, hopefully you'll never think of it the same way again.
Well, you mentioned the Dow, and that, I think, for probably the majority of the last 100 years has been kind of what people have looked to kind of understand what the market's doing, and then in a certain sense try to derive what is the economy doing from that. And so I just wanted to give a brief history about what that is. Now, an index is an indicator or a measure of something, and there's many indexes out there outside of the financial world, but in the financial world, we're usually talking about a market index or a stock index. And what that is it's an indicator of change in the value of some underlying basket of securities. And so in the case of the Dow, it's 30 individual companies. In the S&P 500, that's actually 500 individual companies. And the way that those indexes came to be, or indices, is it was a really long process starting in the mid 1800s. And people out there said, okay, I know at the time railroads were the big thing and they were this indicator of growth and industry. And so originally companies started monitoring and saying, hey, what are the railroad companies doing? How are they doing? And so that was kind of the original thing that they were monitoring, and they had these lists. And eventually S&P and the Dow ended up kind of making that list known. So in the case of the Dow, in 1896, there was the Dow Jones companies. They actually teamed up a statistician, and Charles Dow, who was the editor of the Wall Street Journal. And they said, we're going to make this index and it's going to tell people what the market's doing. And so they threw 30 companies together. Most of them were industrial type companies because, I mean, if you go back to the late 1800s, our economy was highly industrial, right? And so that's where that came to be. So today, and they changed over the years, but today we end up with the Dow and the S&P. And I will say that a lot of people, even in the financial world, talk about investing in the Dow or the S&P. And if you believe that you are invested in one of those, you are actually invested in something that tries to replicate what those are doing. So you can't actually invest in the S&P 500, you can't actually invest in the Dow, but you can invest in a mutual fund or a financial instrument or something else out there that tries to replicate what those indexes do. So I'm actually looking at the quote unquote market today and how these indices are doing. And right now the S&P is up, the Dow is down, the NASDAQ's up, the Russell 2000's down. And so these things are moving in different directions. Well, why is that, right? If you're watching that and you say, why is the Dow up and the S&P down or vice versa on some particular day? It's because the components that make those things up are different. And again, going back to that 30 companies versus the 500.
Zach, one thing that always fascinated me, I know we're not going to get into this today, but it always fascinated me the analysis when people would go back and they would say, well, okay, what were the 30 stocks in the Dow back in 1970? And then and then you track those companies forward 10, 15, 20 years later. And the stunning thing was how common it was for some of those companies. Not only were they not on the Dow anymore, but in many cases, the company didn't exist anymore. And so, we see the same phenomena in the S&P 500. And so I guess the takeaway from that is that these indexes are always evolving and they're always changing. That's another aspect to them that's just kind of fascinating, I think.
Yeah, and they are. They're constantly, of course, there's companies that we all know of that were big names decades ago that you don't really hear about anymore. Kodak, for instance, right? Huge company. Everybody knew about Kodak, dominant in their industry. And today they're not what they used to be. So I'm going to share a image here. And
hey, Zach, while you're pulling that up, we got an email with a question of, do you know who the Jones was of the Dow Jones? You mentioned who the Dow was, but did you ever come across who the Jones was?
Yeah, so Charles Dow was the editor of the Wall Street Journals. I think the guy's name was Edward Jones. Edward Jones. Yeah, that was Edward Jones, and I'm something tells me that may be where the company by the same name came from, but he was a statistician. So I'm gonna have don't I'm not very confident of that, but Jones was a statistician, and so I think Dow had the idea of what he wanted to do, and Jones was the one who figured out how to do it. He was the number cruncher.
All right. Well, I just thought I'd slip that in. Go ahead and share what you were going to share.
Okay. So hopefully this popped up on the screen here for everybody. Let me scroll down a bit. So this is an image that's showing that blue donut or circle, think of it as a pie chart. And sorry about that. It is showing of the 500 companies, what portion of those are the 5 largest companies. And if you look at the graph there, you can see that the first one, the largest one, is Microsoft, and then Apple, and then Amazon. And so these are just companies that make up the index. They're not good or bad. But why is it that some of those companies make up a bigger portion of that donut, Bob?
You're asking me?
Yeah.
Oh, sorry, I was trying to unmute myself. Well, I mean, you know, the way that these indexes are done is, and this is one of the biggest things that people, I think, don't often understand about them, is that they don't, like, in this case, we're talking about the S&P 500. It's not that each company is given an equal amount of the value of the overall index. They're basically taking the market value of these companies, 500 of them, and they're adding them all up, and then they're making it into a security, as you talked about earlier. So the effect of that is that the companies that are the biggest, i.e. the Microsofts today, Microsoft, and what is that, like $1.4 trillion worth of what they're worth on their stock is trading at, I guess, when this slide was made. That's what I guess you would refer to as their weighted value to the index. And you know, this is one of the biggest factors that people need to understand when I think, when they're looking at the typical S&P 500 performance. And I know you're going to talk about that more here as we go along.
Yeah.
But most people don't get that. They just think, oh, well, there's 500 companies, and so each one of them is one. It has an equal weight to every other one, but it's not the case.
Right. Yeah. In our minds, we want to think, okay, well, there's 500 companies, and if one of the smaller companies moves up the same amount as Apple or a larger company, for instance, or down, they're going to have the same effect on how the overall thing moves. And so in our minds, we may want to default to, oh, there's 500 companies, each one is 1/500th of the index. But as you can see, the portion that they make up and how much they contribute to what that index does is dependent on that company's size. So when we're looking at the image here, you can see this was not as of today. This was as of February 11th. So it's changed a little bit. We've had coronavirus since then. But $1.42 billion was the value of Microsoft on this day. And so if you took all the Microsoft stock out there and the price of each share times the number of shares, basically you could use that to derive what the value of the company is. And so as of this day, according to its share price, Microsoft was the most valuable company in the index. 1.42 billion, Apple was 1.41. And so you can say, well, that doesn't make any sense. Why is a bigger company going to affect things more? And the thought behind that is that larger companies in our economy affect the economy more, right? So if the burger stand down on the street corner on Main Street goes out of business, that really doesn't affect the US economy. But if a super huge company like maybe one of these, or an airline manufacturer or something like that, goes bankrupt, then that's going to have a substantial effect on our economy. So when they were originally designing these indexes, they said, you know what, the larger companies tend to have a more of an overall impact that we feel. And so we want to make them more important and give them a bigger say in something that we're monitoring. And so that was the thought here. Now, as of today, I mean, we're looking at this, and these 5 companies make up at least 10, close to 15% of the index. There's actually, if you were to add the next 5, the top 10 largest companies of the 500 make up over 1/4 of the total value of the index. So they actually make up, it's close to 26% today. And Apple has actually moved up to number 1 since this chart was made. And so they're always changing, but you can start to think now and imagine, okay, well, if you have 10 companies out of 500, what those 10 companies do is responsible for 25% of whenever we talk about what the S&P 500 did. So that means that the other 90% or 490 companies out there are the remaining.
It's the other 98%. That's the thing that's mind blowing about this.
98%, right?
10 companies would only be 2% of the 500, and in a year like we're seeing right now, if you didn't have those 10 companies in the index, I don't know what the results would be, but I guarantee you we wouldn't be anywhere close to fully recovering from what the sell-off was. And so people need to understand that. We're basically seeing largely a tech rally. And that's great. Anything that makes that index go up, a lot of strategies have the S&P as part of their mix, but you just need to understand that what you're really looking at here is a very small 2-3% of the companies out of those 500 are driving a large share of what you're seeing happen on that index.
Right. And some of these largest companies here make up 5% of the total result. And this 2020 has turned out to be a year where if most of you look at your account and compare it to an index, you will see a disparity there. And it's a bigger disparity than I've seen in the 10 years I've been doing this. And maybe, Bob, I don't know if you can remember a time whenever you've seen such a disparity between different types of companies as we're seeing now with this virus situation.
No, I've never seen it this broad of a difference. And, it's a time and a season when being diversified is actually hurting you a little bit. But, wisdom tells us that don't get caught up in the short-term reality of that. You focus on the long-term. We still believe long-term in the value of being diversified because this is not going to continue forever. We know that. We just don't know, when it's going to change. But when it does, you'll be glad that you stayed diversified.
Right. And our investment team that we talk with on Monday mornings yesterday, we were looking at a chart or a graph that showed historically how these top 10 largest companies in the S&P 500, or what has always been the top 10, it's changed through time, but sometimes we'll have a 10 or 15 year period where the top 10 companies in the index are very much outperforming the other 490. They're leaving them in the dust. And I would say that that's the period that we've been in for 8, 9, 10 years now. And so someone out there may say, hey, well, I'll just invest in these large companies because they're doing really good. Well, if we go back farther than 10 years from now, there was about a 15-year period where the largest companies were very much underperforming from the ones that were smaller than them. And so just like every investment strategy or theme out there, I mean, we cannot emphasize enough that every investment strategy has its season where it's in favor, and then it has a time period where it goes out of favor. And so we are constantly trying to help people not get caught up in comparing to these index too close. As you mentioned, Bob, there has been a time period recently where the cost of diversification has been real. There's been a high cost to that. But the last thing that we want to do is, put all of our investments in this small basket of a few large companies, and then, the next 10 or 15 years, those are heavily underperforming. So in the long run, we definitely want to stay diversified. On top of the S&P, there's another index called the Russell 1000, and It's actually just double the number of companies as the S&P. And I just wanted to spend a couple minutes talking about that because I've been watching that for most of this year, basically since the coronavirus started. And over the last 6 months, we've seen that index heavily lag some of the other indexes like the NASDAQ, which tends to have a lot more tech-based stuff in it. And there's actually, if you take those 1,000 stocks that are in the Russell and you separate them into growth companies versus value companies, that growth tend to be more young. The tech stocks are usually growth companies. The value companies are more of the older, more stable. A lot of them pay dividends. If you separate that 1,000 into the two groups, one of those groups is up about, the growth group is up about 25% since the start of the year, and the value group is down about 15 or about 5%, or no, I'm sorry, about 10. Because there was about a 35% gap when I looked at that last week. And you can say, okay, here you have 1,000 stocks, they're all in the exact same index. Yet if you just separate them into two groups, you get a 35% difference in what those two groups are doing. And so all that to say that for you guys that are watching, and we have the investment strategies that we'll take a look at when we do our reviews or anytime that you'd like us to. We have to try to look to something to base, to gather an idea of what those strategies did and how they performed, right? So some people will look at the Dow, some people will look at the S&P, but at the end of the day, we really want to focus on the plan and go back to that and say, okay, how much do we need to have return be over the long term per year, and really let that determine how we're invested and stay diversified. I know that's always going to be the best strategy for your financial well-being. I don't know, Bob, if you have any other thoughts on that, and really staying the course with the plan.
Yeah, I do have one thing. We did get another email with another question. I'll tell you in a second, but we've got about, I don't know, 5 minutes or so left. So I want to give you a chance to talk about two things, Zach, that I think we wanted to touch on. One was, we've been spending most of our time talking about the Dow and the S&P, but again, you asked about early on, back in the 80s and the 90s, when one of the things we would often explain to people is that, look, there's over 10,000 mutual funds out there. How do you know which ones are the right ones for you, right? Well, today, you can make similar comments about the different indexes out there. And this might give you a kind of put the ball on the tee to talk about this a little bit. The question that we got by email was, it's really simple. What would an investor do with an index? That's pretty basic, right? The other thing you might touch on before we run out of time is you kind of address that question is how broad are these indexes, Zach? I mean, the S&P is all about U.S. companies only, the largest 500 U.S. companies, right? But speak to just the sheer numbers of accounts, of indexes out there, and also, some of the breadth of them, some of the different areas they cover, and then maybe try to address that question, and then we'll be just about out of time.
Yeah, and so if we take a look at anything that someone can invest in, there's U.S. stocks, there's stocks that are in Japan, right? Japan has a whole group of stocks of companies that are in Japan, and they have a name for that index. It's the Nikkei index. There's an index called the EAFE, which is an index that represents developed countries internationally. So think of Australia, Japan, the Far East, Europe, but not Canada and America. And so we're constantly trying to create ways of measurement, which is what, going back to the beginning, that's what these indexes are. So if you're an investor, how I would use an index is really trying to uh, derive what a certain basket of stocks, be it through geographic reason, geographic location, or an industry that they're in, to see how they're doing. So for instance, there's an index for the financial sector in the US. So you can go out there and find an index that is basically just companies that are in the financial sector. And there's people out there that they say, I don't, all I want to invest in is the financial sector. So you can find a mutual fund or an ETF that tries to duplicate the result of that index. And so as an investor, when you see an S&P 500 or a Dow, you could buy an instrument that you actually put your money into that tries to duplicate what that does. And so that's how I would say most people are probably using indexes today. They want to invest in a specific sector or a specific market, and so they are trying to find something. First, they're trying to find an index that represents what they're trying to invest in, and then they're trying to find like an ETF or a mutual fund or something that invest in that. And a lot of the strategies that we have, if you drill down and you take a look at the security zone, there might be 10 exchange traded funds in there, and you may see one that is invested in the consumer discretionary sector or the energy sector or financial sector. And so
so these indexes, and I think the last number I saw, there's over 5,000 of them now traded, and they can be an index of a country, they can be an index of an industry, they can be an index of a style of stock. You know, you talked earlier about growth companies versus value. I think of them as exciting stories versus boring stories. You know, long term, the boring stories tend to do really well, but they're not nearly as much fun to talk about. So you can slice and dice these, right, in any number of ways. And it gives investors a way to have a lot of diversification in a single position. And also, if they want to try to get fancy, which we don't really recommend unless you really know what you're doing, but if you want to try to get fancy and you think, you know, that old China, boy, I don't know, I really like them, I think I want to own China. Okay, you can go find an index and do that, right?
Right.
So it's really a wild, wild west out there for do-it-yourself investors. Most of the folks we work with don't kind of consider themselves in that vein, and that's one of the reasons they're working with us. They want to get, you know, some help, and we tend to be a little more, okay, let's figure out what, as you said earlier, what's the right amount of risk for you, for your plan, and how do we build a portfolio that has proper diversification, and, you know, kind of an all-weather type portfolio. And we make changes as we go, but it just kind of depends on the client, their circumstances changing, and also kind of generally what's happening in the economy. Zach, we got about 2 minutes left. Why don't you wrap it up with any last things you want to share, and then I'll give a quick advertisement about next week's discussion.
Yeah, I guess final thoughts on index. If you have someone that you know that is looking at their portfolio and trying to compare it and saying, hey, you know, I'm doing bad or I'm doing well. What they're comparing it to matters. And so if you guys know someone that has some questions about that and they're wondering, does my portfolio, how is it performing? We can all go find an index that makes what we're doing look good or look bad, but send them our way and we can try to find one that's probably relevant. There's also a way that in the industry where you can combine indexes in a way to kind of get something called a benchmark that is actually more relevant to compare a portfolio or a specific account. So, you know, we'd love to speak with them. That's really, I guess, all that I had on indexes. I'm sure this has probably raised just as many questions for you guys as answers it provided. So, would love to speak with you. If you have any additional questions, reach out to me via email or give us a call.
Yeah, absolutely. I think our goal is to try to give people working understandings of these things and make them more informed. And, you know, I'm still learning stuff after all these years, so nobody can know everything.
Yeah.
We know that for a fact. And I think this was a helpful discussion, and people should know a little bit more about what these things are and how they work now. Next week, we're going to be talking about one of my favorite topics, which is charitable giving, and particularly a strategy that we use often called a donor advised fund. You might have heard it referred to as a giving fund. We're going to break that down for you guys and tell you what they are, how they work, and where they can make sense as we use them in the context of doing planning for people. So if you're interested in that and finding ways to get maximum tax advantages from your charitable giving, be sure and tune in next week. Zach, great job today. Thanks, everybody. We're out of time, so we're going to go ahead and wrap it up. We'll see everybody next week.
See ya.